Hi, everyone. Thanks so much for joining us today. So my name's Kelly. I'm the manager of the customer success team at NextChapter. And today I'm joined by Josh from the Student Loan Toolbox. Today we're going to talk about the attestation form. So we're working on an integration between the Student Loan Toolbox and NextChapter so that users can more easily complete the attestation form. So what we're going to go over today is Josh is going to start us off. He's going to talk about what that form is, how you can complete it, maybe some rules and regulations that go along with that form. And then I'm going to hop in later and I'm going to show you how, once we are integrated, where that information in NextChapter will pull from and then populate on that attestation form. So I just wanted to touch on a few things before we get started. The first is that you can use the Q&A feature to ask any questions along the way. Josh is really good about seeing them and answering them immediately on screen. I'm not sure that I will be the best at that, so we do have moderators in our chat today. So if you do have any questions, hopefully they can help you if I can't, and then if we don't get to them, I'll definitely check over them at the end to make sure all of your questions are answered. I did also want to point out that we will be sending links within that chat. The first is going to be a link to the next session that we have. So once we finish here, the next one starts immediately at 2. And then there's also going to be a link for the bankruptcy week pre-registration. So we hosted a virtual conference a few years ago, and we're hoping to do one again later this year. So if you do pre-register and you sign up for a new account with NextChapter and you attend one of these sessions, which you are if you're in this, you will get a free first case filing with NextChapter. So we do encourage you to pre-register and sign up with NextChapter. And then lastly, we will be providing a discount code for the Student Loan Law Workshop. It's a 10% discount, and you'll receive that just by attending one of these events, and you'll get 10% off for any workshop that you want to attend with Josh. So let me have him start us off here, and I will hop on in just a little bit.
All right. Good morning, good afternoon, depending on where you are. Hopefully it's not good night. So today we're going to be talking about discharging federal student loans using the Department of Justice guidance. And we're going to talk about the attestation. I'm going to admit this might be a little rusty because Kelly and I didn't have time to kind of rehearse, but everything is here and we're going to answer all your questions as best that we possibly can. So I'm just going to jump right into it. When we talk about our topics, first, what debts are dischargeable?
Hey, Josh, if you are talking, I don't think we can hear you.
I can hear him.
Okay, thank you. Sorry, maybe that was me.
Okay. Are we still okay? Let me just make sure we are.
I can hear you, Jim.
Okay, thank you. I can hear you now too. I think it was my audio. Sorry about that.
All right. Okay, so the first thing we want to know is what is the debt dischargeable or not? A lot of folks assume that, well, if it's from a university, it must not be dischargeable. That's not true. Then we're going to jump into 523A8, which tells us that student loans are not dischargeable. Then we'll run over the 30,000-foot view of the DOJ guidance. We'll walk through the attestation. Kelly's going to get involved at that point as well. And I just want to finish it with considerations of, do we want to do the adversary, and what other alternatives are there? Okay, Ben, that's a great question. Discharging the student loan debt has nothing to do with the actual degree. You can have a degree, you can keep the degree, you can use the degree, you still get rid of your debt. Okay, that's good question. I've never seen that one before, but I like it. Okay, so, and FYI, I'm from New York and I do talk really fast. So if I'm going too fast, someone say something, I'll do my best to slow down. All right, number one, starting an education debt. Is it dischargeable? Tuition is dischargeable, period. There are a minority of courts who say, no, it's not, but that's changing quickly. Tuition is dischargeable. Are student loans dischargeable? No, pursuant to 523A8. There is, however, an asterisk when we talk about private student loans, but that is not the subject of today's webinar, so I'm not going to answer those questions. Is it owed to the university? Well, what is it? Is it tuition owed to the university? In which case, yes, it's dischargeable. Or is it a student loan owed to the university? In which case, it's not. By the way, tuition converted to a loan is still tuition and it's still dischargeable. There's a little nuances there, but we can, that's something we can answer in Q&As at the end. I want to make sure we get through the attestation. That's what you're all here for. This is the good stuff. All right. So let's jump into 523A8. And let's go through all three sections. AI makes federal loans non-dischargeable, state loans non-dischargeable, and loans that are underwritten, funded, or somehow tied in with a nonprofit. So if you want to know what loans I'm talking about, National Collegiate Student Loan Trust, those loans were underwritten by a nonprofit called TERI, the Education Resource Institute. Those are nonprofit loans. They're non-dischargeable because of AI. Whatever tricks you might have heard about cost of education or any of that doesn't apply to nonprofit loans. EduCap is another example. And Sallie Mae loans from 2006 or earlier also had a nonprofit. So they are non-dischargeable under AI. AII, this section is not a catch-all, even though a minority of courts believe it is. It does not apply to loans, even though a minority of courts say it does. The majority says the word loan is missing, therefore AII does not apply to loans. It applies to overpayment of grants. It applies to, the best example is either military grants or teacher grants, where there was an obligation to serve or to teach for a certain amount of time. And if they don't fulfill that obligation, the grant converts into a loan, but it didn't originate as a loan, so it doesn't fit under the other sections of 523A8. It falls under here. Now, I don't want to get into the weeds here, but Navient has attempted to make loans non-dischargeable under AII, saying, well, maybe it's not a loan, but there's an education benefit. And the 5th, 10th, and 2nd circuits have all laughed at them, I'm assuming, and said, no, nice try. It was a Hail Mary, they lost. And those cases I'm talking about, if you want to write it down real quick, are In re Crocker out of the 5th Circuit. I got it wrong. 5th Circuit, out of the, no, I was right. 5th Circuit is In re Crocker, 10th Circuit is In re McDaniels, and the 2nd Circuit is In re Hamilton. So bar study loans are dischargeable because they don't fit under 523A8 anyway. All right. My email is at the back if you have any questions. I know I'm kind of running through this. And then we have 523A8B. This came out of BEPSIPA in 2005. It made private loans non-dischargeable. Guess what? There was no such thing as a private loan before BEPSIPA. They were all nonprofit loans. Okay, Sallie Mae used a nonprofit for their loans, so they were non-dischargeable anyway. B said, hey, if there's not a nonprofit involved, then it's still non-dischargeable. And so Sallie Mae got rid of their nonprofit after that. So their loans from mid-26 and more recent are all true private loans. They fall under B. So again, does not include bar study loans, does not include family loans. It's got to be an arm's length transaction. And most importantly, B references 221D1 of the IRS code. And if you go through and root around, you'll find other reasons that student loans from Sallie Mae or other private lenders may not actually be a student loan and therefore are dischargeable by right. I talk a lot about this in my workshop. Love to talk to you about it because you may find that you have people that get out of their student loan just by filing a 7. So again, not what we're talking about here today. All right, so that's 523A8. The standard everywhere but the 8th and the 1st is Bruner versus New York State Higher Ed. And it's got 3 prongs: that you can't maintain a minimal standard of living for the debtor and the dependents, that there are additional circumstances that exist and will likely exist for a significant portion of the term of the loan. And 3, you've made good faith efforts to repay the loan. Right now, most people lose because of IDR. And I don't like Bruner because with IDR, it actually creates an inequity. Those who should qualify don't, because their IDR is so small. If you take the average pro bono client, a legal aid client, their IDR is probably 0. How do you take them in front of a judge and say, Your Honor, they can't afford the loan? And Department of Ed says, yeah, but their payment is 0. Where's the hardship if their payment is 0? Yes, there are other hardships on that. Maybe the tax consequence afterwards, or the mental stress of having to fill out this form, this recertification every year. But not every judge latches onto that. And the majority of judges say, no, we don't buy it. So IDR has become an inequity. And it's been difficult. I don't agree with the argument, but it is hard. So let's run in now to the DOJ guidance. Let me give you the 30,000-foot view. This became effective on November 17th, 2022. And again, house rule, put your questions in the Q&A. If it's relevant, I'll ask. Okay, so this is a good question, Samantha, but with federal loans, you can get your loan out of default. I can't tell you how many people lose an adversary because they say, well, I'm in default. I can't have IBR. And they get yelled at by the judge. Get your loan out of default and you can have IBR. Federal loans can get out of default. In fact, the webinar after this one is about Fresh Start, a new program to get out of default in 5 minutes. So default is never an excuse for federal loan. Good question. All right. So the DOJ guidance became effective November 17th, 2022. Here is your bright line rule. The bankruptcy case that you're working on must have been open as of November 17th, 2022. If you have a client with a case that was closed on November 16th, 2022 or earlier, you cannot reopen that case and file a DOJ guidance adversary. You can file a regular adversary, but you can't use DOJ guidance. This is a bright line rule. Please don't test the waters. Now is not the time. Maybe in a year, maybe if there's a new administration that keeps this going, but right now, don't do it. Okay? If any part of that case was open as of November 17, 2022, whether you had a pending adversary for their student loans or something else was going on, if the case was not closed on November 17, 2022, you can do an adversary. Okay. If the case has closed since November 17, 2022, you can reopen it and file the adversary. 7 or a 13 or a 12 or an 11, doesn't matter. This is for federal loans only. Now, I'm not going to rehash this. I spent 2 webinars talking about the difference between an FFEL and a direct loan. FFELs do not yet have directive to use the DOJ guidance. If you have an FFEL loan, it means ECMC, Education Credit Management Court, is going to defend it. Okay? They do not have the directive to follow the DOJ guidance, and they don't have to. We're going to talk about that in a second. Yes, you can file a case right now and use the adversary against it. Yes. It's all about, as long as the case is fresh or opened as of November 17, 2022. So FFEL loans alone cannot use the directive. If you have a mixed file, if you have a client that has both direct loans and FFEL, you should be safe. I've heard unofficially that ECMC will follow whatever DOJ does. So again, if you've got a case with both, you're okay. Private loans will not follow this. And please don't be optimistic like, oh, private lenders are going to follow this too. No, they won't. They don't have to. And they won't. You're delusional if you think private lenders are going to follow. Absolutely not. Okay. Let's compare the standards. The traditional or the Bruner standard, the first prong was the current inability to pay. You can't meet your minimal standard of living. Under the new guidance, DOJ, it is very simple. Income minus expenses is less than whatever the standard repayment would be. That's it. And we're going to run through these. Second prong, under Bruner, there are additional circumstances that will remain for a portion of the term of the lease. Under the DOJ guidance, it's future inability to repay. It's a bunch of check boxes. The more check boxes you have, the stronger your argument, but you only need one checkbox to get through the door. Third prong, under Bruner, you made good faith efforts to repay the loan. Under the DOJ guidance, it's prior efforts to repay. Again, it's check boxes. Oh my God, it's so easy. It's so easy. The third prong, you can't fail, and we'll see why when we get it. Okay, so let's dive into those. Okay, the first prong again, current income and expenses, current income minus expenses is less than the standard plan payment. Now, you can use schedules I and J if they're not older than 18 months. If you're in a chapter 13 and you have amended schedules I and J, and those amendments are not older than 18 months, you can use them. You can also use mean test, lines 6 and 7. Again, if it's not older than 18 months. They want to know what's going on. If the I and J doesn't paint an accurate picture, they want a more accurate picture. Okay. IRS national and local standards are used for comparison, but not quite in the same way. You'll see it on the form. Now, the standard plan for the payment is either a 10-year amortization, or if you have a direct consolidation loan, it's actually a 30-year amortization. And without getting too into the weeds here, direct consolidations actually have a tiered term based on the balance of the loan. If the consolidation is 30,000 or more, if the consolidation is 60,000 or more, it's a 30-year amortization. If it's, I forget what the floor is, but there's like a 10, 15, 20, and 25 and 30-year term. So depending on what your balance is, it's what the amortization is going to be. So yeah, it matters. Do they have $200,000 in a consolidation loan, which gets it a 30-year term, or $250,000 that has never been consolidated and they get a 10-year standard? Honestly, 250,000, they should qualify either way. Okay, so I'm going to answer those questions in a minute. All right, IDR is ignored. They're not allowed to consider IDR. That right there is the biggest thing. Now we bring equity back. So your client, that whether they're a legal aid client or not, if their IDR was $50 a month or $100 a month, that is irrelevant. Now it's based on the balance of the loan. So if your client owes $50,000 and their 10-year payment is, I'm guessing, $250, you've got to show through I&J they don't have $250. If they owe $300,000 and their payment is $1,500 a month, you've got to show through I&J they don't have $1,500, which is why I have a little bit of a contention with other people that give webinars on this. They say above median clients shouldn't be used for this. I'm going to disagree, partially because I'm not a bankruptcy practitioner. But if I have an above median debtor who maybe they're a doctor or a lawyer or an accountant or something, and yeah, they earn big bucks, but they owe $300,000 and their standard payment is $1,500, we go back to the definition. After income and expenses are gone through, do they have $1,500 a month? If they don't, they still qualify. So I think your above median debtors, take it with a grain of salt and look at it on a case-by-case basis. Okay, so Joe, your question is, how do you know if the repayment's 10, 20, or 30? So again, it's 10 years if it's anything but a direct loan consolidation. If it's a direct loan consolidation, then it can be anywhere from 10 to 30, and you can either look through the regs, which will show you what the tiers are, or Toolbox is programmed for it. And when you use Toolbox, it will automatically tell you, A, what the term is, and B, what that payment is. And I'll show you later on the checklist, it'll show you what to compare it to. It gives you the number so that you can do an eyeball analysis of do I even want to go through this or not. So Toolbox actually has the attestation form, and Kelly is going to talk about how that integration works between Toolbox and NextChapter. Okay. The cancellation has nothing to do with the Department of Justice guidance, Nancy, so I'm not quite sure where your question is going with that. Okay, the second prong. Oh, the calculations. As long as you have all of the input correct, yes, you should be able to use the Department of Ed's website. Okay. Second prong, future inability to repay student loans. These are all check boxes. Again, you only need one as a threshold, but the more you have, the better. So they're asking, is your client 65 years or older? That's a checkbox. Are the loans you're looking to discharge, have they been in repayment status for at least 10 years? And by the way, repayment status, I think is bad wording. What they mean is, have they been out of school for 10 years or more? Because it doesn't matter the status. It could be repayment, forbearance, deferment. It could be 5 years of bankruptcy forbearance. It can be in default. It doesn't matter. Is the loan 10 years old since school? And they're not even asking about the current loan. If the current loan is a consolidation, they're not asking how old is that consolidation. They're asking the underlying origination loans. How old are they? If your client graduated in 2013 or before, they have their 10 years. If they graduated in 2017, you're not going to get this box. Okay. The debtor did not complete the education that was paid for with these loans. Okay, so maybe they went to several schools. One of the schools they didn't complete. Okay. Your client has a disability, or a chronic injury which renders debtor unable to work or limits their ability to work. Notice this is not a permanent disability. They're not asking about permanent disability. If they have a permanent disability, you should be doing the TPD discharge, total and permanent disability discharge application. Your client gets rid of their loan in 60 days. But this is just asking any kind of disability that makes them unable to work or limits their ability to work. If they're a part-time worker, this box can still be used. Yes, a new bankruptcy after November 17, 2022 will follow these guidelines, Nancy. Correct. Has your debtor been unemployed for at least five of the last 10 years? Okay, see all these check boxes? Additional reasons. Is your debtor currently unemployed? Are they currently employed, but they can't work in the field which they were educated, or maybe they have special training? I have someone that went to optometry school, but can't pass the exam. So he can't be a licensed optometrist. That's a box I can check for him. They're currently employed, but their income isn't likely to increase enough to make substantial payments. They don't define substantial payments, but it doesn't include IDR. This is not IDR. It just means substantial payments. So to me, it means, can they ever make that standard payment, the 10, the 20, the 50, 30-year standard payment, whatever it is? Okay, why not? Well, whatever their field is, maybe they'll just never make enough. Maybe they're a social worker. They're working in the field they're supposed to, but they tapped out at 50,000. They'll never pay off their 250,000. They'll never make a substantial payment. That's a checkbox. And the last one, for other reasons, the debtor's not likely to make payments for a significant part of the repayment period. Maybe they're on the cusp of retirement. They're not 65 yet. Maybe they're retiring. Maybe they're 64. Who knows? So all of this, these are all checkboxes. Now, when you see the form, the attestation form, there's lots of room to explain what's going on here. Okay. All right, that's the second prong. And the third prong, oh my God, this is so easy. You can't fail this. If you fail this, call me because something's wrong. All right. Again, these are all check boxes. Prior efforts to repay the loan. They're currently making or have made a payment. If they have made a single payment, they check the box. And by the way, a Chapter 13 plan payment counts. So if they've never paid their loan, but you put them in a 13 and they're making payments through the plan, you can check that box. Have they ever applied for a deferment or a forbearance? Oh my God, this is so easy. Take a look at their student aid report. If you see a single forbearance or deferment, not the CARES Act from March of 2020, but any other deferment or forbearance, if they've got one, boom, check the box. Have they ever applied for an IDR plan? It doesn't say they had it. It just wants to know, okay, no, Jill, if they didn't make a payment to the loan, then that's not going to count. Oh, you're asking if the bankruptcy forbearance counts. No, I don't think the bankruptcy forbearance counts for this checkbox for the second one, but I would put it anyway. You know what? Let the assistant U.S. attorney come back to you and say not quite. Have they applied for an IDR plan? It's not asking if they were on it. It asks if they ever applied for it. Okay. Have they ever applied for a federal consolidation loan? Take a look. If they have a consolidation loan, guess what? No, you don't do an attestation form for each federal loan. You do it for the client, not each loan. If they have a consolidation loan, you check that box. Have they ever responded to outreach from a servicer or a collector? I'm willing to bet as soon as you start talking to the client, they're going to tell you about a call with Sally Mae or Navient or Nelnet or Great Lakes. As soon as you know they had a phone call, boom, you check that box. Have they engaged meaningfully with education or a servicer regarding payment options or forbearance or deferment? Look, if they had a forbearance or deferment, they got that by requesting it. Not a bankruptcy forbearance, not a COVID forbearance, but any other forbearance, they can only get it by picking up the phone and talking to someone. So if they've had a forbearance, boom, they had that box. But here's the box that you're always going to check. If they're talking to you, have you engaged meaningfully with a third party that can assist you with managing student loan debt? That's you. If you're talking to them about their student loans, if you're talking to them about IDR, if you're talking about what I talked about yesterday with IDR or consolidating, or what we're going to talk about after this with Fresh Start, boom, that box counts. They're talking to you, it counts. DJ, good question. If they are forgiven under the DOJ guidance, can they get new loans? Yeah, they can, but oh my God. I don't even want DJ, stop asking questions. Okay, Karina, it doesn't matter if they're specifically making student loan payments or if those payments are being paid through the plan, not through an IDR. It's just in general, if there's money going to the student loans, that counts as a payment. Okay, if they haven't made voluntary payments, but there was a wage garnishment, that's still a payment to the loan. Okay, I'm telling you, this is so easy. You guys can't fail. But again, you already got a third prong box because they're talking to you. So the third prong should never be an issue. The biggest issue that you guys are going to have is that first prong. Income minus expenses compared to the standard repayment. Okay. Gosh, I feel like I'm moving really fast here. This is an example. This is what Student Loan Toolbox uses. This is a 30,000-foot view evaluator to find out, should you even dig deeper into your client's history? Do you even want to think about filing an adversary proceeding? This is it. Okay, check the boxes. You'll notice that this bottom box, I've engaged meaningfully with a third party, that's automatically checked because if they're talking to you, it's there. Through our intake, if they mention that they have a disability, this checkbox, I've got a permanent disability, I need to update it. I have a permanent disability or chronic injury, that will automatically be checked. And this is very simple. When you're talking to them, are they 65 or older? Check it. You're going to be able to look at the NSLDS, that student aid report. How old are their loans? Do they get to 10 years? The only thing you're going to need to figure out is their income minus expenses. Is it less than the standard repayment? Now it's blank here because this is a sample, but in Toolbox for the client, it's going to show you what is the payment. It'll be right here. So all you need to know is their income minus expenses less than whatever number we have here? Yes or no? Check the box. And as long as you've got a box for the second, a box for the third, and a yes for number one, boom. You know from a 30,000-foot view, hey, we can do this. And then you can spend the time going through it. Yes, Tracy, and we're going to discuss that the expenses are based on IRS standards. We're going to walk through the form. What I first want to do, and Kelly, feel free to jump in wherever you want to jump in here. I want to talk about the guidance and the procedure that then gets us to the attestation. Where does the attestation fit into all? Number one, you have to draft and file an adversary complaint. I've had people ask me, well, can't we just, put the attestation and send it to DOJ to find out if they think it's even worth it? And the answer is no. Department of Justice doesn't get the file until an adversary is filed. Prior to that, the student loan, the file is still with Department of Education. And no, you can't send the attestation to Department of Education and say, hey, can you just tell me, ballpark, do you think this will work? Absolutely not. They got better things to do. Yes, you can use Toolbox with without coming to my course, Andrew. Of course, using my course will make you better equipped. But yes, you can use Toolbox without coming to the workshop. Toolbox does not work with Best Case. We're happy to do integrations with anybody. But right now we're working with NextChapter. We're very excited about that. So you have to draft and file the adversary complaint. You have to serve the complaint. Who are you serving? Okay, you have to serve. Jill, hold on to that question. You have to serve the Department of Education and the U.S. Attorney General and the local assistant U.S. attorney. They're the ones that's going to appear. Now, you want to serve them for two reasons. One, they need to know what's going on. They have to be formally served. And two, this is the courtesy wake-up call to them, like, hi, I'm over here. We're going to be doing this. Okay? It gets them, they know this is coming. I know my local AUSA. I let them know this is coming down the pike. I actually send them a courtesy copy of the adversary before I ever serve it, just so they know. Okay. Okay, so you have to serve it. By the way, if you're serving anybody else, the only people that you might be serving extra might be the servicer. If the loan is in good standing, maybe you want to serve the servicer. There's only one reason to do that. And I believe it's Max Gardner that talked about this. Notice. I serve the servicer to put them on notice that this is happening. So one, they stop bothering my client, depending on how far you're into your bankruptcy. Maybe it's a fresh 7 and they haven't gotten notice yet. I don't know. But I also serve the servicer because it gets them to get the Department of Education to show up. The servicer has no dog in the show. There's nothing for them to do. And honestly, if I do serve the servicer, if they're a defendant, I will dismiss them as soon as my AUSA shows up. There is nothing for Nelnet or Great Lakes or whoever the servicer is. There's nothing for them to do. I let them out immediately. That's right, Jill. The AUSA does not have a case or a client until it's assigned from Department of Education, which is why I will give them a courtesy copy of the complaint before I ever serve, so that they can pick up the phone and let Department of Ed know, hey, this is coming. Get it going. That's my hope. I don't know if they really do that, but that's the hope. How to win friends and influence people? Be nice. All right. Upon AUSA's appearance, they will provide you a litigation package. Now, this is Jill's question. The litigation package. Thank you, Brian. That's good. Here, AUSA is the assistant U.S. attorney. The litigation package, from my understanding, the Department of Ed is also still working on it, is still creating it, still forming it. It is more than the student aid report. And by the way, the student aid report that you get is the backside of what we see. It's oriented a little bit differently, but they are also giving other information. They're giving payment history if they have it. They're giving assignment information. So it's been in this servicer, then this servicer, then this servicer. So far, I'm seeing now. But I can't tell you specifically what details because I am learning from the attorneys I've worked with. They're all getting different litigation packages, different amount of depth of information. But it does include the student aid. So, which also means that we can actually start prepping the attestation before we get the litigation package. If you want to, you don't have to, because again, under the procedure, the attestation is not due until after you get the litigation package. All right. And then we go on and prepare it. And you'll notice here, if the loan information you get is correct, you get to skip 4 questions on the attestation. All right. So at this stage, I want to turn off the deck and I want to run through the attestation. And again, Kelly, if you want to jump in at any time, now's a good time.
Yep. Okay. Thank you. I will share my screen now. Okay. Can you see my screen?
We can, but it's blank.
Okay. It's blank.
Oh, there we go. Aha.
Okay. Okay. Good deal. So like Josh was saying, once we have this integration completed, the information that we'll pull from your cases in NextChapter will populate from line 15 of the attestation form. So I have it pulled up here, and you can see there's a lot of sublines that go under line 15. And this first section here is going to be for any of your payroll deductions. And just like the instructions of the form say, we're taking this from either line 16 of that means test form. So the second means test form, whether that's 122C2 or A2, we're taking it from line 16. And if one was not generated in the case, so if there was no presumption of abuse, we'll take it from Schedule I, line 5. We have also created a Help Center article that lists out line by line of that line 15, so every subline, and it tells you exactly where that information would come from in NextChapter. So I'm just going to give, since we have this all written out, I'm kind of going to give a general overview of where you can set up that information and where you can find it in NextChapter. So if I'm in NextChapter and this is my homepage, I'm going to click within my case. And since a lot of that first section of line 15 comes from your payroll deductions, you're going to want to visit the income section. So in the income section, this is where we can enter any of our clients' income. If I have new income, I'd click new income. I have some set up though, so I'm going to show you what some of these look like. Okay, so I'm going to run through how we calculate income because since a lot of this information is going to populate from Schedule I or the means test, we use this income section to populate both of those. So it's really important to understand how the income section works in order to know where your information is going on each form. So like I said, we have 3 different types of entering income. You can choose all pay advices, just one pay advice, or the year-to-date subtraction method. If you hover over these question marks, we give a little description of where each one is going. So right now, this income source is showing we're using all pay advices. So that means I'm going to enter all pay advices that my client has received in the last 6 months. And then we're going to add up all of those pay advices, divide by 6 to get that average income for the means test only. So I've entered all of these pay advices. We're adding them all up and then dividing by 6. We're getting that average monthly income for the means test. For Schedule I, though, we're going to use the most recent pay advice or the one of your choosing. So I can choose any of them by just clicking Use on Schedule I. So with that, it means that these deductions for Schedule I, line 5, and for the means test, the second means test form, most of those in this scenario should be pulling from that pay advice that I'm using on Schedule I. So if I'm using this pay advice on Schedule I, my medical deductions would be 143, my domestic support 208. All of these deductions that I'm using on Schedule I will also be applied to the means test. Now, with that said, you always do have the option to override what's being used on the means test. So I'll show you how to do that in just a second. So that's all pay advices. I do want to go over the other 2 calculation methods just so everyone has an understanding of how we're using this information. So I can click on this next one, and this next one will be just one pay advice, which means that we are using, this would be like a scenario if your client has regular income. If they receive in the past 6 months, it's like a salaried employee, maybe they just receive the same thing every month and they will continue to receive that going forward. There's no really overtime or varying pay advices. It's just the same thing pretty much every month. So in this scenario, we're using the same thing for the means test and Schedule I. There's really no difference. And so this is a very simple way of entering your income. There's not a lot of question marks because what you're seeing on Schedule I would be very comparable to what you're using on the means test. And then the last method is the year-to-date method. This is just using your year-to-date income, obviously. So we're going to subtract the first pay advice from the last pay advice and get that 6-month income. You would then want to enter a Schedule I pay advice. So we're using this average for the means test, and then we're using the pay advice that you've entered at the bottom for Schedule I. So with all of that said, now that you kind of understand how we're getting all of that information and how we're calculating it for both of the means test and Schedule I, you can always quickly check as well. So like, let's look at maybe the first line. So for taxes, we're either going to pull from line 16 of the means test, or we're going to Schedule I line 5A. So what we can do is we can look at Schedule I. If you click preview, you can always check what's being used. You can see how your forms are being populated. So if we go to line 5A, we'll see that we have 233 that's being used for taxes, for those tax deductions. If we go down to the means test, so if there is presumption of abuse, we'll see this tab, means test questions. And this is where a lot of the information for the means test will pull from as well. But there's always a section to override what's being used. So for any of those deductions and expenses, you can always click, yes, I want to override them. And we'll see, yes, so 233 is being used currently on the means test. If I want to override it, I can always do that and enter any amount I want. So that is for most of the payroll deductions on the attestation forms. That's mostly the first section. The second section is going to pull from, like Josh said, those it's either going to be the IRS standards or Schedule J, and we're just really referring to the instructions on the form. So for Schedule J, where you would go in NextChapter to enter any of that information would be under your expenses. So let's find one for Schedule J. Okay, so for section 3, subline 3, we would go to expenses, home insurance. And this is what we're going to use. This is exactly where we're pulling it from in NextChapter and what would be populating to the attestation form. So if we go to expenses, what did I say? Home insurance. Home insurance. So we would be using whatever information you have entered here. And when you're looking at the form and even looking through the Help Center article, it's pretty self-explanatory because it is listed out. So like your car payments, what we're using for any car payments would be under vehicles and then your car payment. And then you can also preview Schedule J and see exactly how that information populates on the form. So 320 for your car payments. So that's kind of a brief overview of how you can start entering that information in your case now, so that when these technologies are connected, when we are connected with the Student Loan Toolbox, that's where all the information is going to pull from. I do want to mention though, that once we have everything connected, it's not going to be whatever we populate to the attestation form. It's not going to be one and done. You will have the option to fill out or override the information if you need to. It's not going to be solidified there. So it's a good way to get your cases started now so that you have that information available to you once the integration is completed. All right, so that's just how NextChapter works and how we're envisioning the integration to work. So I'm gonna bring Josh back on, and if he has any other information that he needs to relay to us.
So, yeah, that's great, Kelly. And I'm glad that, really the issue here is we're tired of double entry. And by having this integration, what you've already got in there for your bankruptcy will be able to transfer onto the attestation. You're not doing it twice. That's really the issue. And we're putting our expertise together, our student loan from Toolbox and the bankruptcy from NextChapter. So that was efficient. That's what this is all about. You become profitable through efficiency. All right, let me go back real quick to actually, no, let's walk through the full attestation, which give me one quick second. Okay, so this is the attestation. I'm just going to do a walkthrough on it. First thing to note, notice it says updated January of 2023. The original one that came out in November, it's been tweaked. And one section has been majorly retweaked. So okay. So it was updated January 2023. The header is your normal header, district of whatever, the debtors, the plaintiff, the chapter. This chapter 7 should be open, and on our form, it will open it up. Is it a 7, a 13, whatever it is? The adversary number, okay. The attestation of name of your client, okay, and the request for a stipulation conceding dischargeability of student loans. Again, your client's name here, and that they are over the age of 18 and competent to make the attestation. All right. We start very simply. Their address, what county, what state. And then number 3, they want to know everybody in the household. So they start with you, they start with your debtor. Okay. Your debtor's age and self, they start with them. Then they want to know everybody else. If you are putting minors in here, dependents, don't put their name. You don't have to put their name. No reason to put their name. I just put their age and their relationship. Daughter, son, whatever it is. Okay. This big paragraph essentially says the litigation package that you receive, if everything is correct, and it's right here, number 4, I confirm that the student loan information, education history provided to me is correct. And if it is, you hit yes, you get to skip 5 through 8. If it's not, or if for some reason you didn't get any information, then you need to do 5 through 8. Okay. And they want to know the outstanding balance of the student loans you're seeking to discharge in the adversary proceeding. Now, notice it says student loans, and somebody asked this question: Do you need an attestation for each loan? The answer is no, but you do need to put each loan that has a balance. If your client has already consolidated their loans and all they have is one consolidation, then this is going to be easy. There's one loan. Here's a nugget for you folks. For those of you that are inexperienced reading the student aid report, if they have a consolidation, you're going to see it twice. It's one loan, but you're going to see that they have a subsidized consolidation and an unsubsidized consolidation. Note that the origination date is the same because it's the same loan. It is broken into 2 pieces so they can track the interest. Don't worry about that. It is one loan. You can put it all together in one shot. Andrew, if they're not living away from home during college, the real question is, are they part of your household or not? Okay. If they're at college temporarily and they come home for breaks, they come home for the summer and you're still supporting them, yeah, put them. If they have moved out and they have nothing to do with you, then yeah, I don't think you can do it. All right. So let me go back to this point. But it is asking for all loans. So if you have a debtor where they haven't consolidated, or for some reason they have multiple consolidations, which I've seen, you're going to need to break this out. Toolbox is doing that for you. Okay, it'll give you the ability to list all the loans. It will attach it as an addendum, and it's going to say here, see addendum. So we're not altering the form, but we're making the communication of information easy and organized for your AUSA. The current monthly payment on such loan is, if you have this information, great. You don't get it from the NSLDS, from Student Aid Report. If your client happens to have statements, great. If they don't, okay. The loans are scheduled to be repaid in month and year. Again, that's on the statement. That's not on the that's not on Student Aid Report. Or the loan is in default. Now, if it's in default, that you can get from Student Aid. It's right there. You incurred the student loans you're seeking to discharge while, okay, again, this is where the chart that we're providing is going to be able to break it out. What schools did they attend? What degree were they pursuing? And was there a specialization for them? And then what month and year did they complete the course of study? And what degree did they receive? Or when did they stop attending? You're going to have that. And this, some of it you're going to get from the Student Aid Report. It'll show what's the last year they had a loan at this particular school, and you'll be able to verify with your client. Okay. And then number 9, you fill out regardless of the litigation package. 5 through 8 were based on litigation package, if it was correct or not. From 9 on, you need to do it all. 9, you're currently employed as a, what's your title, employer's name and address, or you're not employed. And then we go into current income and expenses. And this is what Kelly talked about with the integration. Okay, household income, they want to know what the gross is. And then we break it down. I'm glossing over the footnotes. If you want to see the footnotes, it's on the attestation. If they're self-employed, yes. What's their company name? Okay, they want to know gross income from employment, unemployment benefits, Social Security benefits. What else are they getting? Alimony, child support, rent, whatever income they're getting. Then they want to know from other members of the household, gross income from employment, unemployment, Social Security, and other income. They don't care about the source. They just want to know. They want to know all household income. Doesn't sound very, seems familiar, right? Okay. And then question 12 is asking, what proof do you have to verify the gross income? If you're going to use most recent tax return, you check the first box. If you're using an average amount calculated from recent months of pay stubs, second box. And by the way, this is actually wrong. They say 4 consecutive pay stubs from the current employer, but they want 2 months. If your debtor gets paid twice a month, you're going to have 4 consecutive. If they get paid every 2 weeks, you might have 4 or 5 pay stubs. If they get paid every week, you're going to have 8 pay stubs. If they get paid monthly, you're only going to have 2 pay stubs. So forget this 4 consecutive garbage. Give them all of the pay stubs for the most recent 2 months. Okay, so they can see all of it. Or if there's other, if that information isn't accurately reflected on tax returns and pay stubs, what else are you giving them? Tell them what it is. No, Nancy, it doesn't matter if they file jointly or separately. They have the right to know household income. Now, if you can't get it for whatever reason, you're going to discuss it, but it's pretty much an open book. They're going to want to know it all. I mean, at the end of the day, they can't go after the spouse, but they still want to know. All right, 13, in addition, you've submitted other documentation, whatever it is, verifying the source of income. Okay. And then we have the monthly expenses. Okay. Current monthly household expenses do or do not exceed all of this. Now they're only asking for families of 1 through 4. And by the way, it's not even families, they're saying household. So I don't know, does it include roommates that you're not married to? I don't know. You talk to your AUSA and ask them before you fill it out. We're We are all learning together. All right, so again, they're only looking for expenses for 1 through 4 people. If you have a household that's 5 or more people, you're going to skip all of this and go down to the last one. I'll show you in a second. But if you have 1 to 4, do your expenses for food exceed or not exceed these numbers? Housekeeping supply, apparel and services. And again, the integration is going to help you with all of this. Expenses for non-medical personal care, miscellaneous expenses that don't appear anywhere else. And now, if you have, even down here, your total expenses, they're asking total expenses from all of these categories, do they exceed or not exceed these numbers? Here, for this last one, number 6, if you have more than 4 people, add $344 for each person above the 1900, and then answer, do you exceed or not exceed? And now for a household of 5 or more, they're not looking at the details of food versus household goods, whatever. Okay. And then if your household is 1 through 4 and any of the categories exceeded, explain why. If you're a household of 5 or more and your total budget exceeded, then explain why. You get ample opportunity to explain why. Right? Then we have uninsured medical costs. Again, do you exceed or not exceed based on 75 or 153, whatever it is? If you exceed, why? Explain it. Okay, and again, it's more direction here. All right. Section 15, this was the biggest change. Number 14 was the biggest change between the January and the November update. So don't use the November update because it's going to mislead you. Use the January one. It's fresher. They've redone it and made it more simple. All right, 15 again. This is where the integration is going to help you just grab all the information for all the payroll deductions, yada, 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 any other payroll deductions. It's standard stuff. This isn't a surprise to any of you guys. Housing costs, again, mortgage and rent, property taxes, homeowners, renters, insurance, yada, yada, yada. Transportation costs. Now, they want to know per vehicle. Toolbox is going to make this expandable. So if you have more than 1 vehicle, it will duplicate all of this for you. Okay, I don't have the actual site off the top of my head, Joe, but I do know it's going to be in it's 34 CFR 685, which is for direct loans. All right, other necessary expenses, anything that's not deducted from pay, such as court-ordered alimony or maybe daycare. But there's more. Health insurance that's not deducted from your pay, life insurance not from your pay, or dependent care for elderly or disabled folks. And why are you paying? Here's your explanation. Okay, how about, do you owe delinquent federal, state, or local taxes? Here you go. I like this one. Payment on other student loans. Does your debtor have private student loans? Put the payment in here. Okay. Other expenses that you think are necessary for a minimal standard of living that aren't described. Put the number, explain it. Honestly, they're asking for everything. They're giving you every possible chance to explain what's going on and why your loan should be discharged. After you deduct all of that, what's left? After you take your income and you deduct all your expenses, what's left? This is the number they're going to use to compare to the standard payment. Okay. In addition, now pay attention to number 17. This is huge. In addition to the foregoing expenses, I anticipate I will incur additional monthly expenses in the future for me and my dependents for basic needs that are not met. Now, in the example, the Department of Justice does have an example attestation, which unfortunately is the November one. They haven't yet made it to the new one. But here, the example is the debtor has a 10-year-old child and is living in mom's basement. And because the child is 10 and getting older, they need to move out. So here they put future expense of rent. She's going to move out. Now, yeah, she's paying $800 a month in rent for the basement, but when she moves out, it's going to jump to $1,700. So they put it in here and she explained, I need to move out. My child is 10. We're sharing one room. It won't work. This is closer to work, so I won't have as much transportation expense, but the rent is slated to be $1,700 a month. So we're letting them know in the future, this is coming down the pike. Okay, so, all right, that is what I, I had poor timing here. So what I want to do is switch back to what do we want to consider? You can read the rest of the attestation. I'm just going to switch real quick back to, make it work. Back to the PowerPoint. Okay, so you're going to fill out the attestation. You're going to give it to your AUSA. This is not anything you file with the court. If they agree to stipulation, AUSA will do it. It's going to be dismissed via a Rule 7041. They do have the ability to partial discharge if your circuit allows it. DOJ wants an 80% stipulation rate. Okay. And very quickly, what do we need to consider? Do you have an FFEL? If so, you might need to consolidate, but you can't consolidate in the middle of a 13 because if you do, it's a post-petition debt and you can't file an adversary. So you need to think about that. Do they have a disability? Maybe a TPD discharge. Public service employee. How close are they to PSLF? Okay. And if they're a long-term debtor, how close are they to the IDR forgiveness that I spoke about, the IDR account adjustment? So I'm sorry I got the timing wrong in here, but look through the attestation. If you have questions, let me know. Okay. And again, all of that information is, these are acronyms, all right here. You can email me. And I would say if you're registered for the next webinar, please do, because I'm going to be talking about Fresh Start, and I'm going to mention other updates, and I have a feeling we'll have a little extra time so we can come back and revisit this. So, okay, with that, thank you very much. Again, I apologize for the bad timing. Email me. I want to help you guys through this. Okay, this is great. This is so awesome. We're going to get rid of federal loans. Very excited. Thank you for joining me.